A very good evening on behalf of India FinTech Forum. I am Aditya Rajkothari and I have Mr. Anil, founder of Vivify India, who is passionate to expand the credit access in the country. A very warm welcome to FinTech Leadership Series.
Thanks, Aditya and India FinTech Forum for having me on this. I appreciate the opportunity to share a bit of my journey.
Vivify's vision is to offer innovative financial products to customers across their credit spectrum, leveraging technology and data science, with a focus on underserved customers. What led to the start of Vivify India?
Before we started Vivifi India, me and my co-founder Shri were involved in the US subprime lending business. We have, even in the US, as mature a credit market it is, there are about 10 to 15% of the population which is underserved credit-wise, and we were offering. Initially technology solutions. Subsequently, we ran a whole lending portfolio on our own for that particular customer in the US. And as a part of that endeavor, we set up a back office in India. And as we were traveling back and forth, what I realized was a similar opportunity obviously existed in India always. But around 2013, 2014, the green shoots of structured data were starting to be available with Credit Bureau, Aadhaar, and the overall India stack that the government was enabling. We saw an opportunity to take our experience of lending to the subprime underserved customer in the US and replicate that same philosophy to bring credit access to millions of Indians who have been traditionally outside the credit spectrum, but still have access to credit through informal means. And we wanted to bring those hundreds of millions of customers into the formal credit spectrum. That's how we ended up with starting Vivify in 2017, 2018.
That's great to hear. How do you view the credit market for millennials in India? What suggestion would you give to millennials for improving their CIBIL scores?
See, the credit market for in millennials is robust, I would say, in the sense if you were comparing a 20-year-old from 20 years ago to a 20-year-old today, the opportunity to get credit is a lot more. You don't have to go through a bank or a branch or a traditional NBFC. You can sit at home, apply for credit. Previously, you needed at least 3 years of experience to even start thinking of formal credit, especially unsecured credit. But today, there are a lot of fintechs and NBFCs like ourselves who kind of offer credit to these customers. So it is a robust credit environment. However, it also means for a young millennial who is just about getting started in his career, credit is also a responsibility, right? It's not just about accessing it. It's almost more importantly about repaying it. And making good decisions at the beginning of your career kind of hold you well in the long stead, because most millennials may or may not know what a single delinquency on a credit file will stay on it for 7 years plus. So, and that gets factored into every subsequent decision making for every subsequent loan they will apply, and it will increase their cost of funds. And while in the moment it may seem like, hey, I'm missing one payment for 5 days, or okay, I will miss a payment for a couple of months, I'll get caught up later on. Um, those decisions will have long-term impacts. So the good thing for anyone who's accessing credit for the first time is to, one, make sure that you don't overextend yourself, make sure that you can always repay your debt, um, stick to the commitments, make all your payments on or before due date, and all of these will help credit score, and it will help reduce your cost of credit for your life. And that's an important learning that everyone should keep at the back of their mind as they're accessing credit.
Great to hear. Please tell us about your Vivify's open work culture and the process of implementing a balanced hybrid model.
Yeah, I mean, come pandemic, Vivify, obviously, like everyone else, went into a completely offline work culture, work from home predominantly. Even prior to that, we had a very healthy balance of both working from office and working from home. We always allowed remote work. Um, and post pandemic, we kind of are continuing to have the balance. We, however, want more and more physical connect amongst our own team members. So off late, we are having policies that will, while giving giving the employees the flexibility, also ensure that there is a collaborative work environment, both offline and online, and in a physical world. And that's what we are focusing on right now. We are growing rapidly. Pre-pandemic, we were a below 100 people company. Today, we are a 700 people company in less than 2 years. And a lot of good work happens with collaboration. While being on a Zoom call or a work from home, collaboration can still happen, and we have proven it to ourselves. We believe with a lot of our customer interactions, which happen through our call center, because of the various RBI rules which kind of take place within our premises, it is very important for all of our team members to take advantage of looking at how those interactions are happening and what kind of improvements we can make in our product. We have insisted on some of everyone being in office for at least a bit of time. And that has really helped accelerate our post-pandemic growth. And we expect the same to keep continue. Flexibility, like our products, flex pay and flex salary for our customers is very important for us. So we'll still say extend the same flexibility to our employees. But I think the employees themselves sees the benefit of being in the office more often than not.
Definitely. Vivify is committed to providing an access to formal credit and a digital credit card experience for the 400 million Indians. So, what are your views on the regulatory intervention in your industry? Do you have any suggestion to make out the regulator to smoothen out protocols for the businesses?
See, the regulatory intervention was one required, more importantly than anything else, and two, long overdue. And if I mean, for everyone in the space as well as common customers across India, about 2 years ago, we've kind of had a very bad experience with a scourge of illegal lending apps, especially from overseas and China, that caused havoc, which never followed any regulatory rules or principles, and were indulging in coercive collection practices, include that resulted in some really bad outcomes for our customers. So I think regulatory intervention was long overdue, and the digital lending rules that RBI has now proposed are, I think, a foundational step to ensuring sustainable growth for digital lending in India. It as much as we want innovation and when we want to do it at a breakneck speed, lending is a sensitive business, and it requires certain guardrails and rules and regulations that ensure, especially from a customer standpoint, customer transparency, so that the customers know their true cost of credit. Truth in lending is very important, and what a lot of RBI has proposed under digital lending ensure customers understand what they're getting into and what their obligations are, while giving them the ownership of their own data, which was being indiscriminately used for underwriting and collection purposes previously. Now there is a clear guideline as to how much data you can access, how you can access it, and the concept of sahmati, an informed consent to the consumer, is a very important layer as well. So all of those, I think, are important steps to build upon India's digital lending and digital banking growth. Having said all of that, uh, I would, I mean, like any fintech that is innovating, we would want some latitude, and RBI is providing that with some sandbox and environments, which is a great initiative. Um, one of the things that we see very important for our customers is the fact that the customers want flexibility, especially with respect to the amounts they can withdraw, when they can repay. And that kind of an experience is provided mainly with a credit card. And we kind of provide a digital credit card experience, but we would hope that the enabling legislation and the rules will enhance and accelerate the adoption of the credit card like products um, for a large proportion of our customers. Today, there are only 55 million credit cards in India. And if you look at US, a mature credit market, post-Vietnam War, the growth of US was built on the back of consumer credit, which was fueled by credit cards. And we expect, as India is marching to be a $5 trillion economy and grow further, that a similar consumption-led growth is the key, and credit card or credit card like products will be the ones that will drive that. So we hope that the regulator, always forward looking, always looking for the benefit of the country and the customers, will ensure that companies like ourselves will have access to offering such products at scale.
Definitely. How does Vivifi's proprietary AI-driven loan management system is helping the customers?
See, LENDEZ is a AML-driven loan management system. When we are talking about providing formal credit to people who never had access to formal credit, it's about looking at data points, both traditional and non-traditional, looking at bureau reports, looking at bank transactional data, and looking at payment patterns and payment preferences of the consumer, and looking through hundreds and thousands of data points to make a quick loan decision when the customer has applied through on their mobile phone through our Flex Salary or Flex Pay apps. And Lendezi makes it all happen. Um, uh, it kind of runs through the four basic layers of underwriting, eliminating fraud, um, uh, intent estimation, ability to repay estimation, and ability to collect estimation, and comes up with a score that's custom within our company and makes a loan decision, which has allowed us to offer credit to more than 40% of people who would have never gotten credit. And when you look at our customer portfolio, more than two-thirds of our customers have incomes below 30,000. More than half of our customers have incomes below 20,000. If you look at a bank or a traditional NBFC, those are income cutoffs. Like no one below 20,000 would get any unsecured credit, or below 30,000 income wouldn't get any unsecured credit. And the proprietary technology platform, both LendEasy, which is our loan management system, and Ascent, our underwriting platform, are key to delivering those to our consumers.
Okay. How do you view the competition in your industry? Do you have any plans for expansion in abroad?
See, the competition is welcome, especially when you're a young industry. I think it is more a collaborative environment, as well as much as it is competitive environment. We are part of various industry bodies, and we have a very healthy interaction and exchange of ideas, especially with regulation and everything else. It is important for us to collaborate as we compete. And I think uh, we see com competition kind of leading us to higher growth within India. Even today, especially after the digital lending rules, kind of a little bit of rice has been separated from the chaff. In the operations that are not mature are having to reconfigure themselves to kind of build a sustainable business model. And I think the thresholds to offer digital lending in India are much higher now, which is a very good development. And we need a lot of players. When we talk about 400 million people, we are just at the beginning of our journey is just scratching the surface. Even our long-term goal is to serve about 10 to 20 million people. And that itself is a few thousand crores or a few $1 billion worth of loan book. And we alone cannot service that need. We need a lot of like-minded companies that need to that that need to be a part of the ecosystem to service. One of the most important things about lending, it's not a zero sum game like search or social media. And even though we are a digital platform and a digital company, um, in no economy, mature or immature, there is one winner for lending. There will be enough companies that will survive in lending. So, so that's the way we view competition. In terms of market access abroad, we are always looking at opportunities. Um, I wouldn't say that we are ready to step out in the next 6 months or 9 months. But beyond that, we are looking at opportunities in other parts of South Asia as well as Southeast Asia to look for expansion. But that's probably a year away, even in its best case scenario.
You have an experience of over 18 years in the fintech industry. What guidance would you like to give to the young entrepreneurs?
Uh, yeah, I mean, I sound old, right? Like when you tell that I have 18 years of experience, but I have been through three different startups or my own ventures. I've exited two of them. The first two were in the US. Right now, I'm running an operation in India. Um, See, as a entrepreneur or as a budding entrepreneur, the first thing you need to be sure about is there's a huge amount of risk you're about to undertake when you're stepping out of your comfort zone. And success doesn't come automatic or easy, irrespective of what the Economic Times headlines say in terms of funding and funding environment. You need to be sure and passionate about the solution you're offering. It should be solving a real need. And once you have the basics of the fact that you are having a solution that the market needs and you have the passion to execute, the rest all comes and it takes time, and you will see a lot of ups and downs and challenges along the way. And it's never easy, it's never a rosy picture. I mean, there might be one or two who are lucky enough to not face the challenges, but by default, there is a lot more failure than success in entrepreneurship. And you should not let failures pull you down, nor any initial success go to your head. Because believe me, I mean, having in my third different venture, I I sometimes thought success came easy. I thought sometimes thought success will never come, but both are not true. And it will balance itself out as long as the core principles remain the same, as long as you're focused on customer and not valuation, as long as you're focused on revenues and profitability and not funding, the rest will follow. I would always want any budding entrepreneur not to fall into the trap of thinking either customer focus or revenue or profitability are not important. Investors, valuations, and funding are important. Then you got the wrong focus. So just those are the things that held me in good stead. I hope it's of some use to anyone who is listening into this.
Great. I thank Mr. Anil, founder of Vivify India, to share his valuable insights on the credit industry and his entrepreneurial journey. Have a great week ahead, sir.
Thank you, Aditya. I appreciate the time and opportunity again.